a whole bunch of fancy indicators in here of Fibonacci retracements, channel trend lines, all this kind of stuff. The bottom line is that during the financial crisis in 2008 and 2009, gold rallied, or excuse me, light sweet crude oil rallied up and then dropped to $35 a barrel. Now, this is exactly why most of your larger fund managers don't have too much exposure to things like light sweet crude oil, because the bottom line is this thing could just completely collapse at any minute. Buying on dips, not a good idea. Not a good idea one bit. If we're going into a global recession, and I'm pretty sure we are, by what's happening in the U.S., there's very little growth in the U.S., there's very little growth in Europe. It's just a matter of time before this directly affects China. The global demand for crude oil will significantly slow. Speculators will have a very difficult time holding crude oil up. And if we hear one more thing out of the Eurozone, and I think we would agree we are going to hear something out of there, crude oil could be at $75, $80 a barrel in a blink of an eye. Definitely not something you want to buy on dip here. This is something you definitely want to sell into a rally. This is grossly overextended here. We're overbought right across the board. Yes, we're going to pull back. Key level right now, if I was going to attempt longs, would not be in the 95 area. It would be down in this 93.17 area. But again, personally, I would not touch a long trade on this particular commodity. I think that it has an enormous amount of room to the downside. And again, this is not something we have to complicate. All we have to do is bring up a longer term chart of crude oil going back to 2008 and 2009, where it went from $140 a barrel all the way down to $35 a barrel. That is something that I simply would not expose myself to. That is bordering on unmanageable. So again, those contracts are very expensive, so we want to think about this. But from a leading indicator perspective, this again is indicative that the dollar will rally here. Now, these rallies do not form, to clarify, overnight. This may take several days, several weeks to start to develop. But predominantly, the dollar is quite strong. Between October and January, the dollar is usually at its strongest. So this is again something we definitely want to keep in mind here, okay? Because I know I see a lot of analysis on crude oil and natural gas and things like that, and a lot of it, well, you have to take it with a grain of salt, right? We have to look at the correlation to the other markets. We also see here the 10-year note starting to come off. This is more than likely going to start to put some pressure, some upward pressure on the dollar also as these treasuries pull back. We can see that looking at charts, individual charts is one thing, but using the correlation to other markets is completely a different form of analysis, something we definitely want to take into consideration. Now, coming into our Forex pairs this week, Australia-US, again, on Friday has made a significant rally higher, but it made it on Friday in a liquid, thin markets, and again, those kind of moves are usually by early in the week, they give it right back. So you have to be very careful. Now, key levels here, 103.13. We've closed at 102.85. We're still showing a bearish signal here. The position of the predicted MACD, the position of the TSI, they're still in overbought territory, even though we've had a significant move lower. This appears to be a retracement and getting ready for the next leg down. That is the likely outcome here, but again, it's going to be a risk-on, risk-off trade. When we come into things like Euro-Swiss franc, this is an interesting pair. Swiss National Bank intervention. This has managed to hold. We've gone completely flat. We've closed the week 123.80. Key level 122.78. That's where I would be looking to get back into longs, but you have to be very cautious with what's happening in the Eurozone. Because again, if these Italian bond yields, and it's just a matter of time before something else resurfaces. The truth starts coming out. Ireland, Portugal, Spain, there's a whole number of issues here. Like I said, don't labor under the misapprehension that we're at the end of this financial crisis. We are at the beginning, and I cannot stress that enough. That's why I'm warning of the crude oil trade, of things like that, because that can be very, very dangerous, getting long on something only to have the rug pulled right out from underneath you. So right now with the Euro-Swiss franc, the Swiss National Bank has done a very good job of maintaining the apparent peg at 120. So for now, we buy down to that 120 level. But buying up here at 123.80, probably not the best idea. 122.78 I would, however, consider. British pound US dollar, this one here has been a tricky one. We had that big sell-off through the Vantage Point predicted moving averages down to the 158.80, but still some support down there around 158.50, and it managed to recover. The predicted MACD and the predicted TSI still support a move lower. But we've got Bank of England inflation reports this week. I don't think it's going to be overly supportive of sterling. So but for now, it is holding. But this chart looks very similar to the S&P 500 chart. You can see the correlation. Of the last 10 trading days, we have either broke through or tagged the Vantage Point 18-day predicted moving average 6 to 7 of those 10 days. That is not bullish. I'm sorry, it just is not. But pound dollar has been a tricky one. It's gaining support from the cross pairs, specifically Great Britain, Swiss franc, Euro, Great Britain pushing lower. That indirectly supports the pound dollar. So that's why we have to watch these cross pairs very, very closely. But again, my bias on this one, unless we can get above this level up here and around this, up above this 162 level, biased clearly remains to the downside. But again, that will depend on economic data that comes out this coming week out of the US and out of Great Britain. Now, looking at the Euro US, I talked extensively about this one this week. Recommended position short on Trader Planet here, I believe on Tuesday at the 138.50 level. That trade I took myself, booking almost 400 pips on that particular trade. Now, when we look at this chart, this is something that I've made recommendations to my own clients for the last